What is up, everybody? Steve here. I hope you are doing well. Today I want to bring you through an article by the Housing Wire. I want to share this because I think that inventory is tight still and we need to talk about it. So let's dive into this article. It goes on to say the housing market saw inventory fall 4% last week from the week before, and that's a big 1 week change. Does that mean we are headed back to all-time lows in inventory again for 2023? During the last 4 weeks, and especially this past week, we are seeing inventory decline faster than expected. Weekly inventory change from December 30th to January 6th fell from 490,000 units to about 471,000 units. And the same week last year fell from 293,000 to 292,000. Obviously, we're in a much better position than a year ago, but inventory is still dismally low. We are on the cusp of breaking under 1 million total active listings, and if this happens in 2023, it'll be the only second time in recent history that this has occurred. And you can see this graph in terms of total inventory. Historically, the US has between 2 million and 2.5 million. During the height of the housing bubble years, we had 4 million active listings. So right now, under 1 million listings is not a good sign for the housing market. That's going to continue to keep prices elevated until we start seeing more inventory come to market. The article goes on to say, I think the bond market is getting ahead of the Fed with the inflation story. We still have a tight labor market and mortgage rates are already falling. Now imagine if the labor market data gets weaker, which is part of the Fed's forecast. It's hard to conceive now that the mortgage rates would get up toward 8%. And I made a side note as of today. Powell was speaking and he said price stability is the bedrock of the economy. They are scrambling right now to do anything and everything to combat inflation, and they're heavily looking at the job market as well. This is critical discussion for housing because the housing market is impacted disproportionately when rates fall during recessionary data. After all, most homeowners, buyers, and sellers who will buy homes are still employed during any traditional recession. This week, we have some crucial data lines. They come out Thursday morning with the CPI data and jobless claims. Inflation levels are still historically high. However, the growth rate of inflation should slow down over the year. Obviously, it will if the Fed keeps increasing the Fed rate. The chart below tracks the CPI index. And as we can see, it peaked in 2022 and is moving slowly moving lower. The Federal Reserve has cautioned everyone not to read too much into the positive data that inflation is falling. However, if this trend continues, mortgage rates won't be spiking higher. Regarding the Fed pivot, although everyone talks about it, it's a no-go until jobless claims break over 323,000. Right now, we are nowhere close for that level to break. Jobless claims fell in the most recent report, and the headline number fell to 204,000. Therefore, I don't expect the Fed's language to change much until the labor market breaks. To sum it up, inventory is falling like it usually does at the time of the year, but some of that inventory can be tagged to the current better demand from lower mortgage rates. In time, we should see the spring seasonal increase. If we don't see that this year, that is a double net negative for the housing market. So what happens from here? What I foresee is the Fed is going to overcorrect just like they did going through the pandemic in terms of overcorrecting, bringing rates down to 0%. And I believe that they're going to overcorrect in this scenario to combat inflation. And unfortunately, it could lead us into a deflationary situation, especially if people are really strapped for cash. And based on some of my other videos, you guys can see the level of credit card debt that consumers are taking. And there is a huge population in the United States that are hand to mouth every single month after their paychecks. As always, I'm going to drop this article in the link below. Let me know what you guys think. As always, I appreciate you guys being with me today. Thanks a lot.